You cannot really understand what is in the hidden layers in COVID. So our forecasting models changed negative 2 weeks before the markets really crashed. But this was not because, our technology was forecasting a black swan. No, the information was already existing in the market. So we will be experience a lot of human robots. They will be, of course, programmed following specific rules. But of course, you never know. There might be somebody hacking them.
This is the Assetizer podcast.
Hello, everybody, and welcome. My name is Tom Lyons, and this is the Assetizer podcast. And today I'm talking with Miro Mitev of SmartWealth, and we're going to be talking about a subject that I'm really interested in. That's the use of AI in asset management and in investing. And I'm really glad to have somebody with us who's been doing this for a very long time, and I think knows a lot what he's talking about. So, Miro, first of all, welcome to the program.
Tom, thank you so much to be here. So thank you for inviting me.
Oh, it's a pleasure. It's really my pleasure today, for sure. And as usual in this show, I'd like to start off with a bit about you. Tell us a bit about your background, and then take us maybe the story up to how SmartWealth got founded.
Yeah, sure, with pleasure, sir. My history goes quite back when I started working with neural networks and artificial intelligence. This was actually in 1997.
That's a while ago.
It's a while, yeah. Tom, I was actually studying economics at the Vienna University of Economics Business Administration. And I was at the final stage of my study of majoring in investment banking and statistics. And I got in connection with neural networks for application for credit worthiness of companies. And this actually changed a little bit my perspective, because I was all the time very strongly quantitative involved with a lot of quantitative models, regression models and auto-regressive models and factor models. And this kind of a technology, neural networks, it's actually changed a lot of my view at that time, because I have seen how powerful these tools are, and how you can use this actually to analyze a vast amount of data. So then I did my decision to write my master thesis by researching about how to use such kind of tools, neural networks, in order to predict stock returns. And I spent quite a lot of time, so almost 2 years, of analyzing and researching using multi-layer perceptrons with different type of 2 or 3 hidden layers in order to forecast stock returns and the distribution of stock returns. And the results were very promising, very interesting, because I compared this with the normal traditional techniques that we had at disposal at the time. And I documented in my master thesis that, using neural networks with almost provided very good and better results than the traditional techniques.
This was something fairly new then. And when you say the traditional techniques, you mean human analysis?
I compared this actually to traditional quantitative techniques like regression analysis, also primarily multi-layer layer perceptrons in actually comparison with multi-layer regressions. Mm-hmm. So actually it was a traditional linear with a non-linear comparison, and the results showed that the neural networks provided almost on every model better results than the regressions models.
And what was the state of the art like then for the neural networks?
It was a quite early stage. So just to give an example, there was not so much neural network simulators that you could actually use at that time. So there was a simulator that I bought for $200. I think I remember it was QNet, something like that. Mm-hmm. And I did this analysis using this QNet multi-layer perceptrons. It was a lot of manual work of preparation of the data, and doing the analysis. But it was quite interesting to see how fast and how good these tools actually approximate and analyze the data. And at that time, this was actually before starting my next venture and my next job with, first of all, with the Investment Bank of Bank Austria, where I was responsible for analyzing stocks by using this kind of techniques for first time. It was in a very early stage. Traditional and analysts banks were actually mostly using fundamental models, cash flow discounted models in order to make analysis of stocks, but not really making predictions out of it.
What's a perceptron?
Multi-layer perceptron is actually the neural networks that you're using for analyzing historical data, and perceptron is actually using historical time series. So you have neural networks that has an input layer and can have a variety of hidden layers, and then there is an output layer that is providing your output. So actually I was using fundamental macroeconomic and technical data, which we use as inputs into the forecasting, into the neural network models. Then there was one or two hidden layers which were transferring this information using different type of transforming functions, sigmoid, for example, function. And then you have an output layer, which is actually giving you your forecast, combining all this together.
And the hidden layers, you don't know what they're doing?
You cannot really understand what is in the hidden layers, so you can monitor what is actually on the input side and what is on the output side. And this is very important to make sure that you have a very controlled information coming into the models, of course, because at the end you don't want to have models that they are just learning noise and based on not meaningful lead forward-looking relationships. So actually you want to make sure that the data that you are using has some kind of a relation, could it be from the fundamental, from the macro, from the technical side to the target that you are going to forecast.
And I think we'll also come back to this question of what goes on in the black box a little bit later. But maybe you want to pick up the story. So you're at the Bank of Austria?
Yeah, there was the Investment Bank of Bank Austria first, and then I got an offer from Siemens to build up a forecasting fabric or forecasting team doing forecasting models. This was a very big project at Siemens. At that time, they had a very strong need for software and services that they wanted to use in their asset allocations for the pension funds and for the treasury for hedging. So the technology that they had developed over the years, it was already available, and it was used for different applications in the industry. For example, for optimization of nuclear power plants, for electricity forecasts, for optimization of traffic lines in smart cities. There's a lot of industrial applications that this kind of AI were used in these early ages, and it was a very interesting for me to see to have this kind of a sandbags that you can start working and start testing, start doing a lot of things, that you have a lot of tools at your disposal, because at that time there was a very limited availability of such kind of systems that you can use
and then
for data.
And you were going to show them how to use this stuff for finance, for their own financial.
Our job actually was to start using this technology and applying it for the financial markets.
Okay.
So actually we start building forecasting models based on the neural networks, environments and technologies. It was a variety of different type of neural networks, variety of different type of forecasting models in terms of mathematical algorithms models like factor models for forecasting, autoregressive models, regression models, genetic optimizations, algorithms, fuzzy logic. So different type of so-called machine learning techniques.
Mm-hmm.
So actually, and these are more or less statistical operations research, machine learning techniques, algorithms that they were available. And we actually started to adopt these models, to build models for application for forecasting. And these forecasts were actually user input in a later stage for optimizing of asset allocation of portfolios.
Okay.
And this was the origination of how I came 25 years ago to work with artificial intelligence.
Okay. So take us up to SmartWealth and what that is, how it started, and what you're trying to achieve.
Yes, actually it's a long way before I decided to set up SmartWealth. I mean, it's almost 16 years, if I count correctly. Experience that I had the pleasure and I'm very lucky to have this experience by providing a high-level research and software as a service to a variety of high-level institutions worldwide. During my time from 2000 to 2010 and then later another 6 years. And I have seen the advantage of all these technologies and the results that we've provided to many clients worldwide, and also the performance which were generated using this technology. And because I already had this kind of experience and all tools at my disposals, we knew what is working, what is not working. We had a lot of research been done over these 16 years, and also a lot of learning by doing, of course, and improving of the technology. Because it's not just a one model, it's a technology that has so many components and so many small things that you have to, to fine tune over the years, and you have to solve a lot of problems over these years. And of course, the technology is developing all the time, and we keep building and keep improving and developing. And this was quite easy task to make this decision. Let's build up SmartWealth on core of the AI. So using the technology developed and used for so many years and waterproofed over the years.
Okay.
Just starting using this for providing products and managing clients' money based on that. And this was the decision.
Okay. So before that, when you were advising all these other companies, that was at Siemens, or?
Yeah, there partially was at Siemens. 10 years was at Siemens, yeah, and then after that there was a in between wealth management company that I joined with part of my Siemens team, and we continued, developing this. And then I actually in 2013 made also index spin-off, where I for first time continued the old-fashioned Siemens business by providing research and providing optimized baskets and forecasts as a service. And 2016 actually decided to make the final step and close the circle and provide the entire chain actually, from forecasting, optimization, and also implementation of the investment advice. Then you need to be an investment manager.
Right. So this is so now you're actually managing
Exactly.
client funds for the first time.
Exactly. Now we are actually managing clients' money based on the technology, and we have also our own products that we are working also with you together.
Absolutely.
Some of the products, yeah.
And I would love to get back to that, and we'll get back to that at the end of the program. But what I'd like to to stick with, because the story of AI fascinates me. I mean, as a layperson. So you've seen the technology evolve already for 30 years.
Yes.
For what I'm saying, at least, I mean, in a hands-on way.
Yes.
Maybe you could tell us a little bit about how that evolution went, and I just want to get a sense of the change, of where the breakthroughs are, of what's different now. I mean, obviously, everybody now knows about LLMs, which we're not talking about actually here necessarily. But I'm just curious on about how that, how that trajectory went from somebody who was kind of there.
Yeah, it's a long journey. We had at the very beginning, actually the algorithms, the mathematics behind didn't change too much. But the infrastructure around changed, and this is change for good. So this kind of a technology requires a lot of data, but also a lot of history. So when we started 25 years ago, there was a valuable data history, but not so long. So primarily for American corporations, stocks, their work information, but for many others actually were not available. In order to build reliable models, you need data, because everything is based on data. So the history over the last 20 years, you got so many additional data points, which makes the testing and developing of your models also better than it was 25 years ago. So the second is very important, the change is the data connectivity. So at that time, there wasn't cloud solutions. So we used 7,000 computers in Siemens over the night, calculating together when employees went to home. So we actually were using this as a calculations. So the computer chips and the speed of calculations increased dramatically. So nowadays you can, and over the years, you can test much more hypotheses by just having a higher speed of testing it.
Okay.
Of course, it's on the one side is good because you can test so many new ideas and hypotheses. On the other side, it's very challenging stuff because the big problem that people are very often underestimating is the overfitting. So it means that as much as longer hypothesis you test, you will find something that it will be working. And when you are building forecasting, any models, it doesn't matter which, always you have a very strong risk of overfitting, because you finally have to build a model, you have to train the model, and you have to do this with data with so-called out of sample, in sample data first. That data is known, presented to the model, and you have to calibrate, you have to fit, you have to see that the model is learning with this data. And of course, you have to select the model finally. And you always tend to select models that are working good. And then the more models you have and the more hypotheses you're testing, the higher the risk is that you will be picking up a model that is performing very nicely, but is actually an overfitted model. The model that learned the noise, that learned, fitted to the data, and is not stable over time, so it will very likely not work in the real environment.
Okay.
And this is something that it's
kind of telling you what you want to hear.
Yes,
in a way.
And when you're starting to use it, then actually it's not usable anymore, because it learned the noise, it learned the data, and this is for any kind of models. It's very, very important to work with with models or with data that what is in the data. So at that time when we started doing this 25 years ago, there was the terminus was data mining. So the data mining means more or less that you have a so huge number of data that, of course, using neural networks, so you can analyze this data. But of course, if you don't have enough history and you are using time series analysis, then you have so many Freiheits parameters in the models that you are actually overfitting by just training the models. So you have to be very selective which data you are using. And this is, it's not easy because especially in the financial markets where we're using the technology, all markets are very highly correlated. It doesn't matter, which kind of asset classes and so on. The markets are interrelated and intercorrelated. And this kind of a structure is changing all the time. It's not constant. So this is very difficult to find a stable lead-lag relationships, leading relationships that you have to identify it in the data in order to use them as a predictors.
Mm-hmm.
Yeah, because you don't want to say what is the price today of S&P 500 by knowing that the euro dollar, for example, is strong today and the interest rates go up today. So, for example, so you want to know what is this application from the environment, all this data which are interrelated with each other. What is the application of the price of S&P 500, for example, for the next 1 week or next 1 month?
Mm-hmm.
And based on this information today, you have to make your decision. And there's so much noise in all this data. And it doesn't matter how many data you are analyzing and you're using, the noise is huge. So you actually are able to predict probably from 100% to be right in terms of the return that you will be predicting, probably 5% of 100 possible.
Yeah.
So it's a very, very few.
Okay.
So, and if you have a transaction costs involved, and if you have not efficient system and product process working on that, then this very small advantage that you are able to forecast, then it goes out.
Okay, so 5% is the advantage you're giving yourself. Yeah.
So normally 90% of the forecasting models of the companies that are involved with forecasting of financial markets, they produce 0% R square. So actually they're forecasting nothing.
Okay.
It's a 50-50.
Yeah.
So it's very difficult to be on this 10% that they have the ability and they're showing over the years to be able to have some kind of a positive R square or explanation of the returns that you are forecasting consistently over time. Yeah. And if you have this kind of a 5%, it is enough to be over 50%, 50-50.
Okay.
So you will go of 55-60 in terms of hit rate, if you like. But this gives you the edge. Only this gives you the edge to make a outperformance against the benchmark and against the competitors.
Okay, it doesn't sound like a lot.
Yeah, it doesn't sound a lot, but is a lot. Yeah, because 80% of the actively managed funds, they are underperforming the market.
Yeah, this I know.
Yeah,
Yes.
and this is fact. Why? Because they are not using forecasting technology and just optimizing, minimizing risk or optimizing portfolio based on risk is not enough, because you are not covering your transaction costs and you don't have any more information than the entire market. Yeah. So it's a combination of both. You have to have a reliable technology and models, but you have to have a very efficient and reliable process in order to execute it. It doesn't help you if you executed this too late or wrong. And this was one of the reasons why I decided to set up or to create SmartWealth, because I have seen over these 16 years of providing valuable information that it's a valuable information. If you are correctly implemented, you can generate excess return. But I have seen so many not really, and also by professionals, not really implemented, overruled, for example, of forecasts.
Yeah. Okay.
So
there's more going on than just the AI analysis part.
Yeah, absolutely.
Yeah.
It is not just a algorithm. It's not just when people think, okay, it's a AI. So it is a system that it's built on a different steps, integrated with each other, and following, or working in a full synchronization with each other.
Okay. One of the things that always interests me You mentioned about not having more information than the rest of the market has. What's always interested me, I know it's a bit of a naive question, but I like to ask it anyway, when you're doing any kind of quantitative analysis of markets, is how you deal with the irrational side of market behavior, because there's plenty of that, especially at certain moments of crisis or whatever volatility and stuff. So how does your model, or how do you approach the absolutely crazy human side of behavior, or the behavioral side of the market?
It's a very interesting question. So thank you. I mean, it's very easy to answer it for me because our models are based on hard data. So data that I mentioned having significant ability to forecast. So this kind of elite relationships are very important. So now a lot of information which is coming on the market on a daily basis. So we are in some kind of a semi-efficient markets. So they are not perfectly efficient, but they're very efficient. So now a lot of the information that is coming into the media and whatever kind of information is publicly available. So this information tends to be reflected in a very fast way to reflect it into the price of the assets. So now, of course, in some situations, people start overreacting in positive or in negative way. So, and this is something that in many cases is generating a lot of noise. So your forecasting or your models needs to work with this kind of a noise and to be able to just ignore it. In very often situations is that you can, even if you have a perfect forecast, the structure of the market is, for example, you have a closing day, hours. So you have a lot of information coming after the closing hours. For example, Liberation Day. So the information was released after the closing day. So what happens on the next day, you have a gap with 10% down. And what happens 1 week later, so you have again information which is released during or 1 hour before the closing of European markets, and then you have up of 10%. So in this second example, you could participate because it was during the day, and if you were reading and hearing the information released from the administration, then you probably would be buying. But this information is just not reliable in the sense, okay, what happens next? So you have to have a model that has information based on also in the history that can proven. You cannot build a model just on one signal information. And on the other side, you cannot trade on daily news and daily information very successfully because the nature of the market is very complex, and you have gaps that you cannot close, and you have a lot of transaction costs if you're doing daily trades. So actually, our technology is trying to navigate through this information to avoid a lot of noise and a lot of such psychological factors. We are considering technical factors, which are also very important part of the input factors. But these input factors, they are in combination with the fundamental and with the macro. So you have to weight them. So sometimes they have a little bit stronger weightings, but sometimes they have a less weightings. But you are not just trading or just doing based on only one factor. So the strongness is actually that you have a combination of different type of factors, of leading factors, considering different type of information, and this makes it stronger and robust.
And the model has seen,
and of course,
it's seen in the past things that happen.
For example, COVID. It's also some very often is our technology able to forecast black swans, or black swans is the common.
Or can it tell you if something is a bubble?
Or something is a bubble. So it's very difficult to forecast something that let's say made by a political, by some other decisions that are not really market related directly. So of course you can identify situations that like in COVID. So our forecasting models changed negative 24th of February. So actually 2 weeks before the markets really crashed.
Okay.
So the exposure to equities especially, but also to the risky assets was reduced. Cash was increased. So and this was good because during the crash in March, but this was not because our technology was forecasting a black swan. No. The information was already existing in the market, and COVID didn't start it in March. In fact, it started already in October.
Right.
The year before.
So signals were already.
So exactly.
Coming.
And the markets, our technology is just analyzing the relationships between the different asset classes, between the different fundamental and macroeconomic and technical factors, information, with respect to what we want to forecast. And based on this information, there is a hard data, which is reliable over time. It's changing, of course, but still the relationships are important. At some time, they may be disturbed. So, for example, you have some kind of a regime change or switch. Or, for example, we experienced this year at the beginning of the year, before the liberation date, when there was a lot of asymmetric information on the market, a lot of uncertainty, but the market couldn't really react it normally. And you couldn't see that the volatility, for example, which is also an interesting factor for risk, was actually not so high at the beginning. But there was a lot of uncertainty. And in such market environments, the relationships that the models have learned over the years, they are disturbed for a short period of time. So, and then it's important that the models can work also during this time on the risk management side, that this kind of factors, this kind of a market environment is identified, that the quality of a forecast in such periods is probably not going to be such good. And then, of course, and we have seen the exposure to the risky assets was reduced again. We had also increase in the cash positions, which was also good because reducing risk in such uncertainty is very good. And then, middle of April, again, the forecasting start to be very positive.
Okay, so basically you just get out for a bit.
For a couple of weeks, we were increasing the cash positions again. And then starting from middle of April, we increased the positions again to the risky assets, and even in the booster product, we increased also a little bit the leverage.
So that's all very really fascinating. And another question that I had on my mind is what you've been talking about up to now is really machine learning and stuff like that. Is there room now in your type of analysis for data or signals coming in from Gen AI, from large language models? I don't know, from different. Is that a technology that can add to your data sets in a meaningful way, or not?
Yeah, very good question. Thank you. Absolutely. So what we, as you know, we built also a scientific board and.
Sorry, what?
Scientific board.
Yeah.
And we are also very strongly involved with research, of course. So part of the job of the scientific board is actually to develop also talents and cooperation with universities where we can test, or we are testing and stress testing the existing technology. So it means that not changing the winning course, but trying to make it better by trying to introduce additional technology which could potentially have a better result or lead to a better result significantly. So it means that yes, I think that generative AI technologies, LLM models can add some value, especially of making the technology probably more adaptive on the short run, meaning that LLM models is something that I personally, or we have tested many years ago. We haven't seen that they can be entirely used as a forecasting in the financial area, but of course they have a very strong applications in many other fields. In the financial, they have to be, tested probably again. Now we have much more data. We have much more faster possibility to calculate and to test these models. They're much more advanced now. But the evidence so far, and this we are not the only. Recently, I heard from Citadel that they also confirmed, and also from RQR, that they are also not really having or seeing this kind of positive impact that they were expecting. But we are just testing, and we have to test it anyway in order to see if there is a significant improvement over a entire life cycle of the life cycle. I mean, that you have a recession cycle, you have a recovery cycle. So this is what I mean. So not just in a very short period of time. Then of course we will be trying to test it and then to run it. And as soon as there is a successful life run with the life money for at least 1 to 2 years, then of course we could consider it to apply it in the future as an important part of the technology.
Right, with a different approach, obviously.
Of course,
they use a different.
Of course. At the end of the day, what we are trying to do is we're trying to forecast, and there are so many ways how you can go to Rome, and there is so many ways how you can get to the right forecast for Apple, but there is only one right forecast.
Yes.
Yeah. So now you have to test your models and see, okay, which of these models is actually producing the right forecast. And we have technology that is producing good forecasts, but of course if we find a additional variable which can add more value in improving the forecast quality, then of course we will be using it. But it's not so easy at the moment. We don't see this evidence, but of course we will be testing it. Yeah, it's a interesting technology for anything else, marketing.
Yeah, I know.
I'm using this all day, so I was so happy when ChatGPT came out. I mean, it's a incredible efficiency improvement tool. But
yes, I mean, I use this stuff for marketing communications since it came out. I mean, every single day, and I find it a mixed bag because if you don't already know what you're doing, right, and have that experience, and I don't say that just because I'm an old guy, but I've noticed if these things can lead you in the wrong direction, right? I mean, I noticed also with writing or with communication stuff that you can go. So I always feel bad for the young ones because I'm thinking, okay, I can spot this because I'm doing this 30 years, right?
The experience,
And if I was just coming up now, I'd be like, I'd be more afraid I could be led astray because the models that I've worked with, I mean, they have a tendency to tell you what you want to hear a little bit, or you can almost influence the answer in ways you don't know you're doing, right? By how you ask the questions, how your prompts are, and all this other stuff. So, and maybe that brings us to another question we wanted to talk about is, because from what you've been describing up to now, it seems to me that, I was expecting a very technical conversation, and we're having that, but it seems to me there's a lot of art involved. And to what extent is that, do you see that, your experience being important, and to sort of know when to say, wait a minute, this can't be right, or because it seems it's not just analytical, or am I wrong?
Yeah. I mean, the experience is incredibly important. Experience and the domain knowledge. I mean, I've been doing this for 30 years and nothing else. I didn't change, industry and so on. So this kind of consistency for sure helped me to understand not only the technical part of the equation, but also the how the market is working, how the economy is working. This is the combination of these two: the technical, the application, and then the microstructure of the capital markets. This is something that is incredibly important. I think building models for financial markets, I think you have to start from the very beginning, and this is what I'm very happy to starting with from the very beginning with the data analysis, the models. and then going to forecasts, and then going to optimizations, and then going to products, and then going to executions, and so on. So all this kind of journey is so incredibly important in order to find the right application, the right model for the right target, because there's so many.
Yeah.
And you don't have the time as a researcher, and also in a company, you focus normally to have a good product, you have focus to make margins, profit, whatever, but you don't have the time for testing and developing and all this kind of stuff. So therefore, experience can really help you to save so many years, even if you have so many tools at your disposals, because there's so many possibilities. And you have to narrow down and say, okay, for example, just give an example, you can use an algorithm how to find a local minimum. Okay, what kind of algorithms you will be using? What kind of environment you will be applying in order to come to this, you know? And then you can test 1, 2, 3, 4, 5, and then you can decide, but you already know what it is to be used, yeah? And this saves you a lot of time.
Fantastic. You know, what worries you about AI? I'd like to turn the conversation to that. And I guess on two aspects. First of all, in terms of just your analyses and stuff like that, but maybe stepping back and into the bigger picture. Because you've written about there's power and there's perils in this technology, and a lot of what goes on we don't understand. That's the nature of the tech. So what worries you?
What's worrying me? I mean, AI and all algorithms is something that you can program. I mean, you are programming and you are controlling as a human. And of course, even if you don't understand everything which is inside, you still have some kind of a control of it. But we have to think about the future in the sense that we will be experience next year, or the next maybe 2-3 years, a lot of robots, a lot of humanoid robots that will be coming. They will be, of course, programmed for specific, following specific rules, and not harming people or behaving like should be and so on. But of course, you never know. There might be somebody hacking them or changing this, and the next war, which we will be definitely seeing very in the next future.
Yeah,
I hope
fortunately, I agree with you.
Soon, but it's going to be a, you and I, we have seen this many years ago, the Star Wars. So, and it's going to be, we experience also now with the drones and so on. So it can be, of course, a lot of these power tools can be used also in a very bad way. So this scared me a little bit, that we should be having some kind of a protection and hat that this cannot happen, that very few people can be actually in a power of this kind of control, because this is a very powerful if you're controlling this kind of tools and algorithms. But of course, we have to think about the next gen, which is not just AI, is the first step maybe. We have the next, 6G is coming, the humanoids are coming, and in 5 to 10 years we have the quantum computing is coming. And then this is the real, I think, breakthrough.
Really?
Because it's changing, of course, it's changing the way how you are solving issues, problems that you need many years to solve. You're just solving this for a second or for a minute. And this is changing the way how we are living. So, and of course, it's a combination of all of this. And it can be also used for not human or for compliant reasons, ethical reasons, and this is something that sometimes I'm a little bit scared about.
Yeah, me too.
Yeah.
But it's like not much you can do. It's going to happen.
Yeah, we just need to make sure to, that people in power of these decision makings, and it's a very important to have the control out of it. not keep it out. That the machine is actually starting to program you as a human. So this would be something that quite scary.
Which, by the way, it's not hard to program a human. If you
It's
know
easy.
if you know how to do it, it's quite easy.
It's absolutely.
So, Miro, this has been an absolutely fascinating conversation so far, and I could keep going all night. We're already at minutes, which is nice, and which is long for us, but that's also nice. But I do want to get back to SmartWealth and talk about the product. So you guys are a client of ours here at Gen 2.
Yeah.
And maybe we can discuss a little bit about how that came about and what the AMC is that you have with us. I think it's an interesting and again, the Assetizer is not here to market Gen 2, but I do like to talk about innovative products. And obviously the people we work with are the people we know what's going on. So I'd like to hear a bit about that.
Yeah. I mean, actively managed certificates are, as I also very often saying this, they revolutionized the way of how asset managers in Switzerland are doing actually business. So it's a very cost and tax efficient way for managing our clients' money. And this is the reason why we actually in a very early stage decided to be a part of the ecosystem and one of the pioneers by using actively managed certificates for managing of clients' money. So, and this is how we actually started working with you together, and we are very happy with this cooperation, and we are constantly increasing the number of actively managed certificates that we do together. It is not only the efficiency, it's also for the clients, also the security, which makes a lot. So actually, using a actively managed certificate, you can test in comparison to a normal fund, which is very expensive and it's not such a cost efficient. It's a very nice way to test to some ideas, to build track record, and to provide a fast access to different topics and ideas to your clients. So this is very, very interesting. With respect to our certificate, or to one of our product certificates, we are very not only early stage in the use of the actively managed certificates, but we are using the entire automatization on our side, which was very important, that our fully automated investment process from forecasting generation, optimization of portfolio, but also execution and so on. It's also fully automated, and also generation of the setup of the AMC, and also reporting and all this stuff. And this is also one of the very important reasons that we see also this kind of automatization and innovation on your side with your system. So therefore, we are very happy with the cooperation.
Excellent. And the product itself is?
So one of the products is a multi-asset strategy, which is using so-called core satellite approach. So we have very liquid ETFs from the most famous ETF providers. Something like 50% of the assets are, let's say, managed with ETFs. And then we have the so-called satellites. So we have the single stocks, the most liquid single stocks in the world, which are building the so-called core satellite approach. So the optimization and asset allocation is based on our forecast and our optimization techniques, and also the execution is fully automated. So we have also possibility to increase the exposure to stocks, single stocks, by using maximum leverage of 35%, which is very interesting when our forecasts are very strong positive. So then we can boost the performance by just increasing a little bit the forecasting the buying power, the leverage to these single stocks, and vice versa. We are using actively cash as a very important asset class. So it means that when we have a different negative forecast for the different assets, so we have the possibility to go on cash. And going on cash doesn't mean that we want to be on cash and just doing nothing. No, going on cash is very important to protect the capital of our clients and to make sure that in very bad market environments we are actually staying on cash, not allocating anywhere else, and just keeping the cash the protected, having the budget, waiting when the forecast start getting positive again, and then entering the market again. And then, of course, maybe increasing the cash, the leverage. So this kind of a flexibility makes the product very complex, very interesting. We started one of the products.
Sorry, you don't see market dips as a buying opportunity?
Not necessarily. Necessarily. So we don't see also the market highs as a over bought or bubbles. No. We see actually our forecasts. They are telling whether it's a buy or it's a sell opportunity. Yeah. It's based only on the forecasts. And just remember, people are talking about NVIDIA. I know that many important and good top tier asset managers that they're talking for years that NVIDIA is overbought. But NVIDIA is still going up and up and up. So there are so many factors that are influencing the AI. I wouldn't say AI bubble. It's not bubble. It's just starting. And it's infrastructure. You need this infrastructure. And the Americans are doing a very nice job because they are taking the lead here. And they are getting so much investments in this infrastructure. I saw this at Siemens when we were building infrastructure. You need it in order to be successful over the next 20 or 30 years. And this is, I think now it's the beginning of that. I wouldn't say, of course, it's normal. There will always be recessions. There will always be some kind of a market corrections. And this is the nature of the market. This doesn't have nothing to do with the AI bubble. It's just the normal way how economy is working. And if there is many other factors that are influencing the entire economy, like unemployment rates, like interest rates, like other kind of stock market prices, commodity prices, and many different factors. If they're influencing the entire economy, and the economy needs to be, going a little bit in a recession in order to solve the issues of unemployment or whatever issue of high inflation, then it will do this. This is was always in the past. But we have to be in a position to focus, to see such kind of signs that this market environment will come. And if we see this, something like 3 to 6 months in ahead, then of course we will be reducing the positions to risky assets at the right time.
Okay. But got it. And did I understand correctly? The algorithm or whatever is doing the trades itself?
Yeah, of course. So actually, we have built a full automated execution. So it's executing all portfolios that we have just for 15 seconds. So we are only trading the most liquid stocks and ETFs in the world. So it's just and it's we are monitoring everything, of course, as our portfolio managers are monitoring the process. See that everything is doing well. Sometimes you could get some rejections for any reason. It has to be investigated what it is on the broker side, but normally 99% is
the trades go through
and full automated. So it's a nice feature to have, and this makes the entire process and also the pricing very efficient.
Well, Miro, this has been an excellent conversation. I really enjoyed it. Thanks so much for coming across the lake to visit us tonight. Thank you.
Tom, it was a great pleasure. Thank you so much.
Welcome.
Thank you.
This is the Assetizer Podcast.